Hello, very good morning to all. I'm Kelvin here again. Welcome back to today's daily dose of market insights. Very good morning to all. Today will be the second day of the brand new month, August, Tuesday, 5th of August 2025. So as usual, before we kickstart our gist of the daily dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. So as usual, before we kickstart the gist of the daily dose, which is the intraday technical outlook on all those broad-based cross-asset classes, let's have a quick recap what has taken shape yesterday in terms of news flow, economic data release, if there's any, and as well as their impact on the intraday movement of all these broad-based cross-asset classes that we cover on a daily basis. That means, i.e., the 4 major US dollar pair, the 6 major stock indices globally, and as well as the 2 key commodities market, which is gold XAU/USD and the West Texas crude oil. So let us start with the performance of the intraday performance of the major US stock indices first. So for those who followed my daily dose on a frequent basis, what I did over here is that I do a combination of fundamental and technical, and from there we are able to actually get a outlook, intraday outlook on where the key levels and the directional bias will be for all the major broad-based cross asset classes that we cover on the intraday basis. So for those who yesterday I do mention that despite the intraday sell-off in the major US stock indices last Friday, induced by the rather weak non-farm payroll data that surprised most consensus on the downside, not rather the upside. The SPX, the Nasdaq, the Dow Jones Industrial Average, which is the US Wall Street 30 that I covered in my daily dose, all sell down to a key inflection level where we potentially expect at least a intraday bounce, and the bounce actually took shape nicely right exactly at or above their respective short-term pivotal support, which I highlighted for you guys in my yesterday's daily dose, and all of them had hit the first resistance level. So the SPX rallied by 1.5%. The top performer is being the higher beta Nasdaq 100, up by 1.87%. Why higher beta? Because that consists of AI-driven mega cap technology component stocks that has been the leading forefront of this ongoing medium-term rally since the 7th of April medium-term swing low. The Dow Jones Industrial Average also play a catch-up, up by 1.34%, and the top performer is the small cap Russell 2000, up by 2.1%. And if you look at the heat map of the S&P 500, deeply in the green are those mega cap technology stocks, driven especially those AI related business model. Nvidia is up by 3.6%. Google also part of this AI team play, up by 3.05%. Metal up by 3.5%, given that Metal CEO now is actually heavily concentrating Metal into this AI space as well by having this super intelligence division. And Microsoft, without doubt, being part of OpenAI shareholding, up 2.2%. Apple, not that fantastic because given the fact that Apple is pretty much late in the AI game, but up marginally 0.48%. Amazon down by negative 1.44%. So overall, the majority of the mega cap technology stocks is basking in an intraday bullish momentum, and that actually lead the positive feedback loop into the S&P 500 and as well as spreading into the Nasdaq 100 as well. And if you look at the heat map of the S&P 500 breaking down according to the 11 sectorial all right, okay, the key 11 sectors over here. So the top sector concentrated heavily on the mega cap component. We have a significant weightage by the mega cap components, which is communication services. So Google is part of Alphabet Google slash is part of communication services, follow my method as well. Top performing sector yesterday, up 2.58%. The technology for sure will be based on Nvidia, up its heavy component is Nvidia, up by positive 2.07%, and across the board is almost all green rather than red. And the underperformer is energy, up marginally 0.11% due to the weakness by oil price after OPEC Plus continues to do a production hike for next month, which I covered yesterday. All right, and with this performance in the strong performance in the so-called the major the major US stock indices, the FX market kind of drifted sideways yesterday after that sell-off of the dollar that was seen on ex-post non-farm payroll data. So what do I mean by this? So if you look at this is the plunge on Friday. This is the 5-day rolling performance of the US dollar against the major currency. That means what I did is I plotted US dollar as $1 equals to how many euro, $1 equals to how many sterling. So I normalize it. So if all these lines are heading upwards, that means that the dollar is showing strength against the major currency. If these lines are pointing downwards, that means the dollar are showing weakness against the major currency. So it's very easily visually easy to see. So after that steep sell off, okay, over here exposed FOMC on last Friday, the dollar sold off, and what we could see now is that the dollar now trying to do a setback. All right, so we know that in the FX market, things don't go directional in one line on the intraday basis. That means after significant movement, there could be a snapback rally or a snapback decline. So I could see over here right now, the dollar has been consolidating after the steep sell off. And what we could see now is that the dollar is trying to actually stage a minor bounce. Okay, so if you look at the 1-day rolling performance of the dollar, okay, the dollar is actually bouncing right now across the board. So later I'll share with you some of the intraday movement on the major dollar pair is showing mixed technical configuration, especially on the euro dollar going to trade sideways. And some currency are still showing some strength against the dollar, but one particular currency is actually showing weakness against the dollar, where for today the dollar could strengthen against this particular currency. That's for the intraday technical outlook segment, which I'm going to cover for you guys. But overall, the net dollar picture over here is that the dollar potentially will continues to remain weak from a longer term perspective. Why? Because the market participants in the Fed funds futures market now has priced in almost a high chance that the Fed will cut rates on the 17th of September meeting. So that's the next upcoming meeting. Still recall very quickly is that last week, not too long ago, on the end of July, which is last week, the FOMC meeting concluded with no cuts, and Fed Chair Powell delivered a less dovish, stubbornly message, despite two FOMC members dissented against his the FOMC of standing peg. Two FOMC members wanted to have a cut, but then Powell during his press conference dosed down this dissentment and saying that he's still got to be data dependent. And right now the data is pointing to him that the labor market has started to turn weak, and that actually increased the chance of a September cut dramatically. So right after Fed Chair press conference, the chances for the 17th of September Fed cut was rather lower. It was about 40%. And right after the FOMC, right after non-farm payroll data, upon the release of this non-farm payroll data, the odds increased to 60% over here. And right now, yesterday it jumped to 80%, and as we are speaking right now, it increased further to 96%. So it seems to us that the market is now looking for the Fed to erratically turn dovish on the 17th of September, and I think a 25 basis point cut. So that actually potentially could put a cap on dollar strength. And if you go down the aggregated probability, that means i.e. looking into expectation in the next couple of meetings based on the Fed funds futures traders trading behavior in the Fed funds futures market as being compiled by the CME Fed Watch tool over here, is that market is now looking at potentially there could be a chance of another cut coming into the October meeting as well at 58%, all right, to bring it down to 3.75% to 4%. Then thereafter, not a high chance of the third cut to come in the last meeting of the year, which is 10 of December 2025. So that is only a chance of about 40% chance as well. But this number has been increasing lately. So if this number starts to bump up to 50% or more, that could be potentially dependent on one particular key economic indicator data that will be released today. Later I'll share with you guys what is this data to watch. Right, it's more centered on the services activity in the US, so I'll cover that later. Right, so that data released today could actually shift the pendulum to see a potential increase of a third cut on the 10th of December 2025 to bring it up higher to the 40% chance that market participants in the Fed Funds futures market is looking at it right now. So net overall, the Fed Funds futures market traders are looking at two potential interest rate cut this year, a rather high chance to come in 90% on September to bring it in on 17th of September, pardon me, to bring it down to 4% to 4.25%, then 58% chance to bring it down further, another second 25 basis point cut to 3.75% to 4.4% on the 29th of October meeting. All right, so that potentially could continue the ongoing medium-term downtrend phase of the US dollar that has been in place since the start of this year. Right, and with the dollar weakness coming back into the picture, we start to see gold prices trading towards the upper limit of that sideways range configuration that has been in play since 3 months. That means, i.e., since the fresh all-time high that was printed at 3,500 on the 22nd of April. All right, so right now it's approaching the upper limit of this range over here. Right, so right now gold price is trading almost unchanged. So given that from a medium-term perspective, it seems to be moving up towards medium-term. That means talk about multi-week perspective. It seems to be inching up towards the upper limit of this sideways range at 3,435, 3,500 level. But on the intraday basis, for today, later I'll share with you there could be a potential chance of a setback to come into today's session, given that short-term intraday technical indicators for gold is being overstretched at this moment after Friday's rally and yesterday's showing of this daily spinning top candlestick over here. All right, so later I'll share with you guys what are the key levels and the directional bias that may unfold in today's intraday session for gold XAU/USD. So now next up will be the West Texas crude oil over here. So the West Texas crude oil continues to plummet, all right, as expected yesterday. All right, so if you look at the daily chart of the West Texas crude oil, it continues to inch downwards for 1, 2, 3 consecutive sessions. Yesterday it traded down by negative 1.7%, down negative 1.7%, and now back towards the lower limit of this range configuration that has taken shape since the low of 24th of June at around the 65.20 level. All right, over here. All right, it's very close to this level, 65.20. So what we could see over here is that it's now back towards the bottom part of this range. All right, so far oil price has been trading in this kind of very choppy sideways range configuration since 24th of June. So that's close to about a month or so already, and this range will continues to evolve continues to evolve in the next few weeks based from a technical analysis perspective. All right, so later I'll share you guys in the short-term intraday perspective where is the directional bias for West Texas crude oil for today. But for now, it still continues to trap in the range. Fundamental factors is not supporting a very sharp rally on West Texas oil now because the Iran-Israel situation has started to die off. From a supply demand perspective over here is that with the non-farm payroll data, weak data that is coming in, potentially there could be some form of lesser demand from US consumer. And on the supply side, there could be a supply glut coming into the oil market, especially OPEC Plus members continues to do their production hike as being portrayed on the last Sunday weekend OPEC Plus meeting. All right, so now what are the data to look out for today that has just released? One thing I want to share with you guys will be tier 1 Chinese data, which is the Caixin Services PMI, released on 9:45 a.m. just a while ago before the start of our daily dose at 11 a.m. The number came in better than expected and continues to be in an expansionary mode. So market was expecting, the consensus was expecting at 50.4, it came in at 52.6, and also higher than the previous print of June at 50.6. We came at 52.6, pardon me. So if you look at the trend of the Caixin PMI data, the latest one for July inch up higher from June's 9-month low and exit market expectation of 50.4. So this 52.6 is the fastest expansion in the services sector of China since May 2024. So that's close to about a 13-month high, driven by inflows of new business and renewed increase in foreign demand. So there seems to me that the services activities in China is actually pretty much resilient despite this ongoing trade tension between US and China. So that also created a bit of support that's being seen on the Hang Seng stock indices over here, the benchmark stock indices of the Hong Kong market. So take it away that the Hang Seng is being used as a proxy for foreign interests in the foreign gateway, foreign flows towards the China mainland stock market. So the HSCI is up, no, marginally unchanged right now, but the higher beta Hang Seng Tech is up by 0.12%. Hang Seng HSCI, the Hang Seng China Enterprise Index, which consists of the key China H shares listed on the Hong Kong stock market, almost unchanged at 0.04%. Whilst the mainland China CSI 300 is up higher at 0.3%. All right, due to that resilient Chinese Caixin services PMI data that continues to expand and go above expectation. All right, that I highlighted to you guys earlier. All right, so that covers the first segment of today's daily dose. Let us now move on to the second segment, which is the intraday technical outlook segment. All right, so before that, let me expand my screen. All right, so let us start with the FX market first. All right, starting with the FX market over here. So let's start with the euro dollar. So euro dollar yesterday, we flipped to a neutrality stance after the rally that took shape on Friday as expected, hitting our resistance at around the 115.80 level. So we flipped to a neutrality stance on Monday, which is yesterday. So latest technical configuration on the hourly RSI is not that great. So after fetching that bearish divergence that took shape on Monday, and yesterday, right now, it broken down below a parallel trend line ascending support that I drew from the low of 31st of July. So with this breakdown of this parallel ascending trend line support on the hourly RSI, it indicates that there is no sign of upside momentum, and potentially there could be a further sideways movement on the euro dollar rather than the revival of a bullish tone. So with that, I will actually be more cautious right now on the euro dollar because there could be a dip down on the euro dollar towards 114.60, which is, if I do the Fibo retracement of this sharp intraday rally from last Friday low to its high, that also constitute with a 0.618 golden ratio retracement as well. So for now, I'll be flipping to a neutrality stance on the euro dollar, neutral between 116 figure and 115.20. A breakdown below 115.20 potentially could see the acceleration of this corrective decline taking shape towards the 140.60 level. But once hitting close to the 140.60 level, I'll be on the lookout for bullish reversal candlestick to actually hop back to a bullish bias on the euro dollar, given that from a fundamental perspective, the factors are still supporting dollar weakness rather than dollar strength. So that's for the euro dollar. Next up will be the sterling dollar. So the sterling dollar continues to hit our first resistance yesterday at 133.15 before trading sideways. So I'll be still having that bullish bias on the sterling dollar, given that the hourly RSI is still holding above the 50 level mark over here, and also continues to hold above that former descending trend line resistance, broken out, turns into a pullback support as depicted by this dotted green line over here. So previously was a resistance, did a bullish breakout on Friday, pullback supported, which was then after that it continues to hold support on this parallel pullback resistance, now turns into a parallel former descending resistance, now turns into a pullback support level, and it hasn't hit the overbought level yet, despite last Friday's strong push up over here. So with that, continues to maintain that bullish bias using 132.10, because price action hasn't broken above our first resistance yet. So I do not want to tighten my pivotal support to be so tight. So first support level to watch will be this congestion over here. Okay, at 132.45 area, but pivotal support still remains the same at 132.10. So 132.10 short-term pivotal support on the sterling dollar still maintain that bullish bias outlook for today. Above 133.15 exposes the next intermediate resistance zone at 133.80/134.10. We also confluence very closely to the 20-day moving average as well. Only a bearish breakdown and an hourly close below 132.10 that would invalidate today's intraday bullish bias to see a retest on last Friday minor swing low area at 131.70/131.40. That's for the sterling dollar. Next up will be the Australia dollar against the USD, which is the Aussie dollar. So the Aussie dollar continues to trade in a sideways fashion as well after last Friday bounce. So still no change, still watching out the 64.20 as my short-term pivotal support level, maintain that bullish bias, but first resistance to watch will be 65 figure level. Only a breakout above 65 figure level potentially visits 65.40/65.50 next. However, a bearish breakdown below 64.20 will see the extension of the corrective decline sequence extending further towards the downside to test the medium-term pivotal support area at 64 figure 63.90, which confluence with the 200-day moving average as well. Right, so that's for the Aussie dollar, still maintaining that bullish bias using 64.20 as my short-term pivotal support level. Next up will be the dollar yen. So the dollar yen slide and hit our support level at 146.80 before now shaping a bounce. And why very interestingly over here is that what you could see, we start to see a series of lower low, right? There's a lower low over here. But interestingly, the hourly RSI has started to shape a bullish divergence right now. So with this bullish divergence and yesterday's, we call it support level has already been met. And right now there could be a potential snapback counter trend rally on the dollar yen to retrace certain portion of the losses or the minor decline sequence that has taken shape since last Friday high all the way down to today's Asia session low over here. So we've given this element that is evolving on the dollar yen. For today, I will flip to a intraday bullish bias for this counter trend rally to play out on a minor time frame basis. So using short-term pivotal support at 146.80, 146.60 level, which is today's Asia session low. All right, so potential counter trend rebound resistance level to watch 147.65 followed by 148.15. 147.65 is the 20-day moving average. 148.15 level is the rejection level that has taken shape yesterday. And if you do the Fibo retracement of this entire minor impulsive down move sequence that has taken shape from 1st of August all the way down to the low of 5th of August, today Asia session low, that consists the 38.2% Fibo retracement. So if we start to see a bullish breakout above 148.15, then potentially this minor counter trend rebound could extend further towards the 50% retracement and the graphical former minor congestion area of 148.75. So once you approach towards 148.15, 148.75, I'll be very cautious. I may not want to remain bullish anymore because the fundamental factors are still supporting dollar weakness. So I'll be looking out for bearish reversal candlestick on the dollar yen to flip back the honors back towards the bearish bias thereafter, because potentially that minor counter trend rebound may have already ended upon hitting the 148.15, 148.75 level. However, if price action refuses to shape that minor counter trend rebound and continues to plummet downwards, then I go to respect the price movement. Breakdown below 148.80/60 will continues the bearish bias towards 145.85. So that is the 50-day moving average, I think, as the next near-term support level. A breakdown below 145.85 potentially takes up down towards the key support level at 144.50. So what's this 144.50? So let me put it 144.50. So this 144.50 is a key medium-term support level. because number one, it confluences with the congestion area of 4th of July, and most importantly, is the ascending range support that is still in play and keeping the bulls from breaking down lower since the low of 22nd of April 2025 low, now becoming the medium-term support level at 14450, because it's a running ascending trend line over here. So this is what I mean, right? It's a running ascending trend line. So right now, this ascending trend line is acting as support at 14450. All right, so that's for the dollar yen over here, flipping to a intraday bullish bias, because right now we may have the tipping point or the exhaustion point of this minor impulsive decline sequence that may have ended in today's Asia session, due for a potential counter trend rebound scenario as supported by the bullish divergence seen on the hourly RSI using 14680/60 as my short-term pivotal support level. Two intraday resistance to watch for this potential minor counter trend rebound to play out: 14765, 14815. A breakout above 14850 may see the rebound extending towards 14875. Then thereafter, I'll be flipping back to a bearish bias on the dollar yen. All right, so that sum up the intraday technical outlook on these four major US dollar pair. Let us now proceed to the major stock indices, starting with the Hong Kong 33, representing the Hang Seng Index. So the Hong Kong 33 continues to remain rather resilient after yesterday's bounce from our pivotal support level, and also the bounce out from the lower limit of this medium-term ascending channel that I drew from the low of 2nd of June. Hourly RSI continues to shape a higher low over here. You could see there's a higher low right above the 50 level mark, indicating that upside momentum still remains intact for now. So with that, the first, okay, let me highlight, delete this. Okay, so the first support level to watch, okay, will be this push up. All right, this Monday candle push up over here, and also the push up of this former minor swing high now turns into a pullback support at 24,480. So unless we have a clear breakout above 24,890 during the afternoon Asia session, then I would tighten my short-term pivotal support to 24,480. Okay, first for now, just in case of any wild whipsaw, I don't want to get whipsaw so easily, given the nature of the Hang Seng, the intraday movement of the Hang Seng Index. I will still be rather prudent and maintain my key short-term pivotal support over here at the 50-day moving average, and also confluence with the rising ascending channel support, medium-term ascending channel support from the 2nd of June low. So still remains at 24,140 as my short-term pivotal support. Maintain that intraday bullish bias above 24,890. Seek out 25,220 next, followed by 25,520, which is the minor swing high of 29th of July. So unless we have a clear bullish breakout above 24,890 after in the afternoon Asia session, then I would tighten my short-term pivotal support to 24,480. All right. However, if price action don't goes up as intended and starts to break down erratically below 24,140, today's intraday bullish bias will be invalidated to see the extension of this corrective decline sequence, exposing the next support level in near term at 23,680, which is the minor swing low area of 4th of July and 7th of July. So that's for the Hong Kong 33, still maintaining our intraday bullish bias. Next up will be the Nikkei 225, which is the Japan 225, representing the Nikkei 225. So price action continues to be rather bullish at 40, now hitting our first support level at 4,600 level. Right, tested it during today's Asia session and do a pullback, and now attempting to break out above it again. The hourly RSI continues to flash out a clear higher low over here after that bullish divergence that took shape yesterday, and continues to trade above the 50 level mark and hasn't hit the overbought level yet, indicating that short-term upside momentum still remains intact. So first support level to watch out for today will be the 20-day moving average over here at 40,300 level. So let me put it in writing, 40,300. All right. So later in the Asia afternoon session, if we have an hourly close above 40,600, then I will tighten my short-term pivotal support to 40,300. So right now, using a slightly upward adjusted support from 39,740 to 40,130 right now. So 40,130 is, if you do the Fibo retracement of this ongoing rally, is the golden ratio at close to the golden ratio at 61.8%. and as well as this congestion area over here for 1st of August last Friday and today's and yesterday's Asia session, right? Minor congestion area before it did a bullish breakout. So 40,130 adjusted short-term pivotal support, still maintain my intraday bullish bias on the Japan 225 representing the Nikkei 225. Next resistance to watch after 40,600 will be 41,285, which is the minor swing high of 31st of July. Above it, seek out 41,610, which is the minor congestion area of 24th of June and 25th of June, 24th of July and 25th of July. So for now, still maintain that intraday bullish bias. Watching closely the pivotal support at 40,130 to maintain it. If we start to see a bullish breakout and hourly close above 40,600 later during the afternoon Asia session, then I will tighten my short-term pivotal support to 40,300. Right, so that's for the Japan 225. Next up will be the European stock indices, starting with European stock indices, which is the pardon, Germany 30 over here representing the German DAX. So yesterday we were neutral on the Germany 30 as it hit an extreme oversold level after last Friday's sell-off. So last Friday's sell-off has this indication of a bearish breakdown between of this sideways range configuration that has been taking shape since the all-time high of 10th of July over here. And if you were to do it, if you could look at the daily time frame over here, so this daily time frame since the 5th of June former all-time high and the 10th of July all-time high, for all-time high, this particular movement in terms of price action is a potential medium-term double top scenario. All right, so given this appearance of this double top scenario on the Germany 30, I'm not so confident right now to have a bullish bias on a very short-term basis. So on a very negative medium-term perspective, it could test the 23,020 key neckline of this double top. All right, the neckline support of this medium-term double top that is forming on the Germany 30. So with this appearance of this double top that is being formed on the daily time frame chart, there could be a risk that the Germany 30 could start to evoke further weakness on the downside, given that the higher time frame chart is not so rosy. And now it's yesterday rally has now approached the former minor range support, sideways range support of the Germany 30 now turns into a pullback resistance and also very close to the 50-day moving average. So upon breaking down this 23,930 level, we see a very sharp intraday deceleration to the downside on the Germany 30. So this is for sure an inflection level, all right, for the best. So using this inflection level of 23,930 short-term pivotal support, and if we are fast approaching it, we will now have a bearish bias on the Germany 30 for today. First support level to watch will be at 23,600, followed by last Friday intraday low at 23,390. Right, so flipping to a bearish bias for today on the Germany 30, using 23,930 as my short-term pivotal resistance level. Only a bullish breakout above 23,930 that would invalidate the bearish bias to see the price action floating back towards to retest the 20-day moving average, acting as the next intermediate resistance at 24,210 that previously also confluenced with the former minor swing low of 29th of July to 31st of July now turns into a pullback resistance level as well at 24,210. So that's for the Germany 30. Next up will be the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 rallied as expected and hit our first resistance zone at 44,250 / 44,390. So with the hourly RSI hitting the overbought level, there's no bearish divergence that's being formed yet. So there could be a risk of a minor pullback at the start of the European session, heading into the early part of the US session as well. So pullback support to watch out for will be at 43,905. And if we do the Fibo retracement of this very sharp rally that has taken shape from the low of last Friday NFP induced sell-off, right? So that's around the 38.2% Fibo retracement. So using the golden ratio at 61.8% Fibo retracement, and also the minor congestion area of last Friday and before the start of the US session, where you see a minor rebound, a minor V-shaped rebound that took shape. So this will be my pivotal support level. First support 43,905, pivotal support for today, 43,750, slightly adjusted upwards to actually maintain that bullish bias after this potential minor pullback that could take shape to actually erase that overbought condition that's being seen on the hourly RSI. So after this minor pullback has taken shape, potentially the US Wall Street 30, which represents the Dow Jones Industrial Average, may continue its bullish trajectory for the next intermediate resistance to come in at 44,780, which is the minor swing high area of 30th of June and 31st of July. However, if price action starts to break down below 43,750, then potentially there could be a retest at the 50-day moving average again at 43,475, which also confluence with the last Friday induced NFP sell-off low. Right, so that's for the US Wall Street 30. Adjusting slightly upwards the short-term pivotal support level to 43,750, maintain that intraday bullish bias after a potential minor pullback that could take shape on the US Wall Street 30, as explained earlier. Next up, the S&P 500. So the S&P 500 also hit our first resistance zone at 66,330, 6,348. So given that the hourly RSI is already hit the overbought level, no bearish divergence yet. So there could be a potential minor pullback to work out this overbought condition that's been seen on the hourly RSI, inducing a potential minor pullback during the start of the European session and heading into the US session, early part of the US session. First pullback zone to watch will be 6,305, 6,290 with the pivotal support at 6,270 to watch. So that will be also the Fibo retracement level of 61.8%. All right, if we do the Fibo retracement of this short rally that takes shape from last Friday intraday low, okay, it's the 61.8%. Golden ratio also confluence at the 6,270 level, which is yesterday's US session low, the start of the US session low, where it do the minor pullback and it shaped the short rally throughout the US session thereafter. So still maintain that bullish bias, but with the risk of a minor pullback taking shape first, heading towards 6,304, 6,290, maximum 6,270, which is the short-term pivotal support that I have for today on the S&P 500. Still maintain that intraday bullish bias for it to revisit the current all-time high area at 6,430, 6,450 next. However, if price action starts to break down below 6,270, today bullish bias will be negated to seek out a retest on last Friday minor swing low area at 6,227. So that's for the US that's for the US S&P 500. Pardon me. Next up will be the Nasdaq 100, which is the mega cap technology benchmark index. So the Nasdaq 100 also rallied as expected, hitting our 23,313 first resistance level to watch. So given that the hourly RSI also at the overbought level without any bullish divergence, without any bearish divergence, pardon me. So there could be a risk of a minor pullback taking shape to work out this overbought condition on the hourly RSI. Minor pullback support level to watch will be at 23,060 level. Okay, 23,060 with so confluence with the 20-day moving average. Pivotal support, I will adjust it slightly upwards from 22,650 to 22,900, which is the minor congestion area over here, or from last Friday to this Monday, yesterday's European session area. And if you do the Fibo retracement of this steep vertical up move, right, that also constitute the golden ratio of 61.8%. So risk of a minor pullback taking shape towards 23,060, maximum 22,900. Still maintain that bullish bias after this minor pullback for the next resistance to come in, which is the current all-time high area after 23,313 will be at 23,710. However, a bearish breakdown below 22,900 will negate the bullish bias today for the Nasdaq 100 to seek out the next support level at 22,650. Right, so that's for the Nasdaq 100. Still maintain our intraday bullish bias after the potential minor pullback that may take shape today using adjusted upwards pivotal support at 22,900. Next. All right, so that sum up all the 6 major stock indices. Let us now focus our attention to the commodities market, starting with gold XAU/USD. So gold rally as expected, hit our first support first resistance level at 3,378, and hitting the first resistance level, we now starts to see a bearish divergence. All right, taking shape. Right now, there's a bearish divergence, and RSI has really exited from the overbought level over here. So with this bearish divergence, right now there could be also a very clear sign of a minor pullback taking into picture right now over here. So right now, given this minor pullback scenario, it could actually float down, because now there's this bearish divergence over here. Okay, so right now if I do the Fibo retracement, okay, the 50% Fibo 50% Fibo retracement and the 38% Fibo retracement lines at 3,345 and 3,344 area. All right, so over here the support level still remains the same at 3,334 area, which I have for yesterday, but I said that there could be a minor pullback hitting this 3,345, 3,334 area. All right, so still maintaining that bullish bias on the gold XAU slash USD after this minor pullback take shape over here. So this minor and also a confluence with the 20 and the 50-day moving average as well. All right, so next resistance level to watch after this minor pullback will be at 3,402, 3,402, which is the congestion area of 22nd of July. And if you do that Fibo extension on this potential minor wave 3, okay, that is 2.618, okay, over here. However, if price action plummet downwards towards 3,344, then gold XAU slash USD will negate today's bullish bias to be in a very choppy range, choppy downward drift movement to revisit 3,310 again over here. Upon hitting 3,310, I'll be on the lookout for any bullish reversal candlestick pattern for it to actually bounce back up towards the upper limit of the range again. However, if I break down below 3,310, then potentially it could float down towards the lower limit of the range at 3,264. So watching very closely the first support level at 3,345, pivotal support still remains the same at 3,334. Still maintain that bullish bias for gold XAU slash USD, but with the risk of a minor pullback taking shape for today first before its rally continues to seek out the next resistance level in short term at 3,402. Right, so that's for gold XAU slash USD. Lastly will be the West Texas crude oil over here. So let me share you the intraday outlook. So the West Texas crude oil tumbled down as expected and hit the lower limit of that sideways range configuration that is in place since 25th of June over here at 65.95, 65.20, and the hourly RSI now has starts to exit up from the overbought level or oversold level, right? It has started to exit out from the oversold level. So given the exit from the oversold level, there could be a bounce back up towards the range, the range resistance area again. So using the range support zone at 65.95, 65.20 as my pivotal support level, we will flip to a intraday bullish bias within this complex sideways range configuration that is in place since 25th of June low, with the range resistance coming in at 69.15, 68.50, which also confluence with the 200-day moving average as well. A breakout above 68.15 will push it up to the upper limit of that range at 71.20. However, if price action starts to break down instead of moving upwards towards the range resistance, a breakdown below 65.20 will flip the bias towards the bears for a range bearish breakdown scenario, exposing the next support level at 64.06, which is the former minor swing high area of 2nd of June and 5th of June, and below it seek out 62.50, which is the minor swing low area of 3rd of June and 4th of June. All right, so this is the previous congestion area that has taken shape in early June this year. All right, so that's for West Texas Oil, and that also sum up the intraday technical outlook on all the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So for today, going into the European session will be rather quiet because all these are services PMI data that has already have a preliminary figure released 2 weeks ago. So that could be not be a surprise. So heading into the US session, the key data to look out for will be at 10 p.m. mark, which is the ISM services PMI, which is very important. Why? Because services activity contributes to 2/3 of US economic growth, and the ISM services PMI data has been in an expansionary mode, holding the fort since the start of this year. So let me share with you. So if you look at the trend on the ISM services PMI, it has been at the 50 level mark since the start of this year, 52.8, but in the last few months, it's going to just drift sideways. If you look at the 5-year, the 10-year trend, all right, it's just going to drift sideways over here at the 50 level mark. All right, so market participant now is expecting the services PMI to have a slight recovery to 51.5. All right, so this number will be very key to watch out for as we head into this data pretty much key as to watch out for as we head into the US session today. It will be out at 10 p.m. Singapore time. Right, and thereafter it will be a rather quiet US session without any US Federal Reserve officials speaking, and heading into the early Asia session tomorrow at 6:45 a.m. For those who have interest in the Kiwi dollar and the Kiwi crosses, New Zealand labour market data will be released for Q2 at 6:45 a.m. Singapore time. And for dollar yen and the yen crosses, this will be considered as wages over here. So 7:30 a.m. we have the average cash earnings, which is the average cash earning wages for Japan for the month of June. Market participants expecting a huge increase to 3.2% year on year for the month of June, up from 1.4% that was printed in the previous month of May. Right, so that could have a potential impact on the yen crosses and the dollar yen. So that sum up today's daily dose of market daily dose of market insights. I'm Kelvin here signing off. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.